Hey everybody, welcome to Trading Capital's daily analysis video. I'm your head market trader here. Currently July 5th. Welcome back everybody from the long weekend. It's always nice to have that extra day of downtime when the markets are closed. That being said, the Canadian markets were open yesterday, and as well as the crypto markets are always open. So there's always something to keep an eye on. But nonetheless, it was a much needed break from stocks because right away we're into some crazy volatility on the first trading day back for the US markets. You can see on the S&P 500, and before we start diving into the S&P 500, I'm going to touch base on the S&P, the NASDAQ, gold, oil energies. We have a lot to discuss on energies, and then a couple of individual names, but gold, silver, oil, natural gas, the S&P, the NASDAQ, and we'll just see how much time we have left in this video. But right away, the S&P was under pressure early on in the morning. A gap down led to a massive, nasty sell candle, and then you were trying to make some chop. It looked like you were putting in some bearish consolidation to potentially move lower, but ultimately you started forming these wicks. So you had a lower wick here, then a higher one, and then a higher one. It's almost like you had this three-tail theory of signals that basically implies there's buyers propping up and they're going to defend that price. So as much as it was very impressive to see the gap down and sell off, the rally was even more stupendous, and it was truly impeccable to watch this rally all throughout the day. Early in the morning, you did have very small signs of positivity across the smaller cap tech plays like cloud names, likes of SoFi, SE, Zoom. They were actually holding up relatively better, and that was kind of your indicator that potentially technology was going to rally and lift this market. And it was certainly a lot of heavy lifting that they had to do to pull us out of this bottom zone sell-off here, but there was a lot of weakness in today, with utilities and energy being completely demolished. And then you had the builders, you also had financials significantly under pressure. You had the industrials under pressure. So lots and lots of weakness today in the overall sector. But truly a tremendous rally on the spiders here. If we flip to the daily chart, it's really interesting because now you have been defending this original breakout zone where you got the retrace. And what is very interesting today is it's actually a very intriguing bullish signal for the short term. Now, bullish signals can change on a dime, especially when we are technically entering a recession and likely in a bear market already. But the bullish signal that here on this daily candle formation is that you made a new low here. You made a lower low compared to your previous close on Friday, but you were able to rally and pretty much engulf this whole previous candle. So in the short term, that does prove that you potentially have a little bit more upside up to this 3,900 level. Notice the 3,900 level is going to be your old parallel channel that you were trading in before you had this nasty breakdown. So another secondary retrace will prove to be a potential area to start accumulating a short again. But if you get through that, because you've retraced once here, there is a likely scenario that you go in up to fill this gap around the 4,000 mark. And that gap may just coincide with the mid-July with the a new downsloping parallel channel with a steeper degree of decline. So let's just continue to monitor the SP 500. Obviously, we do have longs in the markets, but we have been accumulating shorts because overall, I don't want to be caught with our pants down in the sense that these markets do turn on a dime. Generally, you wake up, you have a gap down or a gap down. It's more likely that we will have gap downs considering the overall trend. That being said, we are positioned with some quality longs to benefit from any continued rallies. But overall, we'll have to sell the rallies and basically short the rallies at the highs, at key technical levels. Looking at the NASDAQ, the NDX here, you're continuing to trade in this parallel channel. The interesting thing, even though you've pierced and broken and closed, below this parallel channel, you've actually on a technical basis never confirmed outside of this parallel channel. So it does act that this is your support zone that you can use to trade against. So clearly you were kissing on support on the last three candles here, and now you've actually managed to hold it, and you've completely reversed the last three trading sessions, and now you're looking to test this wide range red bar sell-off. You do have the short-term moving averages coming down on you, but ultimately there is the potential to come up and fill this gap around the 12,250 level. that would coincide with a 50-day daily moving average. So you do have tons and tons of resistance, and then sloping down, you'll also have the center point of this parallel channel. So that's more or less a 50% retrace of the parallel channel, and it would certainly be another good area to accumulate short. So let's touch base on oil, but first off, we want to say congratulations on the SCO. What an impeccable call. I mean, we were in that trade for 4 days, and we just netted a beautiful 26.6%, and honestly, some of you could have netted more. Let's just flip to the SCO trade. You know, I sold a little bit early. It continued to drop and drop and drop. Like, maximum profit that someone could have banked was 30%, so an extra 4% more than what I capitalize on. But nonetheless, what a tremendous sell-off. If we flip to the actual oil chart, look at this WTI. Remember how we were talking about this trend line acting as your new level of resistance, and what we wanted to see on a weekly basis was this consolidation. I didn't think we were going to get the breakdown so soon. To be honest, I thought that we would have the breakdown next week, heading into the Fed meeting with a more aggressive, with the mid-July meeting heading into a more aggressive Fed potentially. So the fact that we got this move earlier on just shows you the fear and the potential of how the GDP and the global economy is deteriorating at a faster rate than most analysts had anticipated. And this is why we've been net short energy for a while. Yet again, we're banking huge profits. I mean, the fact that you have so many energy bulls that are screaming to the heavens about oil going to $150, natural gas going to $50 or even $25, that's just absolute lunacy. So nonetheless, amazing job taking on profits. You can see we took our profits right on the US, so basically around this pivot, in and around here. Now, what I'm going to look for is a potential retrace to this yellow trend line again. Let me just fix my chart. So if we get a retrace back to this yellow trend line, I'm going to short oil again. And what the beautiful thing on the WTI here is we're finally cracked that $100 level. So we haven't had a closing basis under 100 since basically the invasion started, because here you had a crack of 100, but you never confirmed below 100. You always ripped back up. Here again, you cracked 100, you never confirmed, but you got ripped back up to 100. Here again, you cracked 100, but you never confirmed, got ripped back up. Never confirmed, got ripped back up. So are the bulls now powerful enough to bring this back up to 100 again, or potentially this 103 retrace? We will certainly find out. If we get that retrace back to this level, just depending on what chart you're looking at. On the WTI, if you get a retrace back to this channel, absolutely pull a short. If you get a retrace back to this trend line, and I'll have to readjust it potentially, absolutely pull a short on SCO again. That's what I'm looking to do. Natural gas, again, it had a hard sell-off. It is just making bearish consolidation, potentially for another move. I've re-isolated some levels. I'm looking at a pierce of $5 between basically the $4.50 range and the $5 range will be a potential accumulation zone for natural gas. That one's going to have to be a very quick and nimble one, because I do think with the backdrop of a faltering global economy, things could certainly change very quickly on a dime. Energies fall impeccably fast. We're still holding our VLO short, so we do have some exposure, and we're beautifully double digits in the money on that already. We also banked a lovely 17%. Some of you could have banked more on Carvana, so amazing job. Beautiful 17.25%. So 2 winners in our pocket this week, and they are massive winners. I love paring down our long risk when we're definitely in a global declining period. This is an economic cycle we don't want to mess around with, and we're certainly on the track once again to continue to print profits. And despite us pulling these profits off the table and accumulating more shorts to put our portfolio once again in that more defensive zone, considering in this environment, you may have caught on to my strategy yet or not, but as I pair off some longs, I like to start looking for potential new opportunities in the long space. But as I pair off shorts, especially since we're in a declining trend, I don't like leaving my net long exposure more than my net short exposure in this market. Yes, you can have rip your face off bear market bounces, but the overall trend is now to the downside. So if the trend is your friend, you have to have more net short exposure, because I've seen these markets turn on a dime and sell tremendously hard, and there's certainly some assets that are still overvaluated. And my thesis is, once we start really seeing the real estate market crack, that is going to be the signal where liquidity really starts to get squeezed out of these markets in hopes to support the assets that they need rather than what they want. Someone doesn't really need to own Apple stock. They want to own Apple stock. Someone doesn't need to own Tesla. They want to own Tesla. But if you really need a place to live, it's one of the, essential needs. Maslow's hierarchy of needs. Shelter is there. So obviously that's why real estate takes a little bit longer to crack. But I do think once it does start to falter, you'll certainly see an uptick in delinquency rates and an increased liquidity squeeze on the overall market. So congrats on the beautiful two massive winners. We did started accumulating a short on Teladoc. We've done that a couple times already. This is just more of a defensive play. And then we're also shorting the ITB. One of the reasons we're shorting the ITB now, you can see that it came perfectly into this gap fill. So ITB, we played up here around the $60 mark, shorted it, made this collapse, covered it basically down here at the 49. It was a beautiful double-digit gain. I've been eyeing this up. We finally got the retrace, filled a key technical gap. You're right under the moving average. You're into resistance. You do have potentially a secondary gap here that you could float up and fill. But nonetheless, that'll be our second zone to accumulate a short. If for some reason it gets through that, you have a final gap fill up here, which will act as a beautiful level of resistance. But overall, I love accumulating names that have just had a massive decline, that are in a downtrend, have had a nice, beautiful bounce to the upside, retraced essentially more than 70% of this move, and now it's in a perfect technical area once again to start accumulating a short position. And again, I started accumulating a larger position in this specific short. I went right away with a full 2.5% because I really do think that the housing market and the construction market is going to take a big faltering hit in the next 6 to 12 months, and maybe sooner. These ETFs have been under pressure since the start of the year. They've declined drastically. Generally, the physical real estate market lags all of these home constructions or the IYR ETFs by 6 to 12 months. So the cracks in the physical market should start showing up as we speak. Obviously, when you give that assumption, it's talking as a broad assumption rather than individual areas. Certain areas in cities or states or towns are going to be affected slightly different, which is why you have that wider time frame. But overall, in terms of where the real estate market is going, it has to go one direction because it's been too inflated. I mean, you have the Bank of England now exploring 50-year mortgage period rates. Like, are you kidding me? An amortization rate of 50 years? That is just asking for a debt trap for life. And the amount of interest that you would have to pay over 50 years instead of a shorter one. I mean, the system is broken. I mean, how do people even pay, on the 49th and 50th year? What the hell would their mortgage payment be? So, I mean, the system is clearly broken in the sense that when you start hearing crazy lunatic policy ideas of this magnitude, something usually gives in the market that decompresses these valuations and starts to cause these really short-sighted policy views to change on a dime. So let's just continue to monitor all the real estate sectors. I am still excited for that sector to fall because it's one of the last inflated sectors, which has a huge impact on inflation and overall the economic growth and decline of what a country is going to experience. Real estate is now the biggest global asset in the world, considering bonds have been through a nasty drawdown. But I do think all of the asset classes, the major asset classes, will have their time in this bear market. And that's kind of what we're seeing with energy now. Energy was the leading sector, and now it's falling substantially. Let's just pull up the XLE chart and discuss energy. But you can see energy's had this nasty, we were even talking about this beautiful, if we flip to the longer term chart, we had this monthly resistance line, and look at that pull off. that is a thing of beauty. It's really makes me super excited as a technical analyst when you get those type of factors. Not only was it a weekly topping tail, massive gap down, confirmed to the downside, slicing through key moving averages, and you arguably have a long way to go. And generally, these declines start happening in periods of really negative economic growth. And you had it here from 2014 to 2016. You had it here in your '08 crisis. You also had it here in your dot-com bust. So the cycles are very similar in nature, and I do think you have a combination of cycles from the issues that we were experiencing in 2008. You have some issues that we were experiencing now from the 70s. You have some from the 2000s in terms of the crypto space. You had in 2008 high energy prices. Oil was above $100 a barrel for 4 months before the economy cracked. Well, oil was above $100 a barrel here for basically 5 months, and it's starting to crack. So and you also had the Russia-Georgia war in 2008 with sanctions being put on Russia by the U.S. and G7 countries. So there were a lot of similar dynamics that are transpiring in 2008 that are also transpiring now. So we do have a lot of historic cycles to incorporate together and get the best grasp of what we're potentially going through. Let's take a look at gold, because gold's interesting, and I'm getting a little nervous in the sense that what I'm seeing. I've mentioned in my previous videos that the importance of watching gold, because gold is liquidity, it is the ultimate form of money. And then when you look at what affects liquidity, let's take a look at the US 10-year here. So the US 10-year has actually started rolling over pretty substantially. So it had a nice down day today. It was down 3.38%, making a slight new interim low in the pattern. You are approaching your support here at 2.7. That'll be a big test for the markets. But what we're seeing right now in gold and interest rates is not healthy for any people that have a bullish outlook on the markets. So gold has finally gone negative on the year. Like I said, all assets will go negative in a bear market. That's why cash and shorting are your best friends. Despite many institutions and financial regulators, they won't tell you that. But nonetheless, we have been shorting all year. We have also been going long, and we have been banking profits tremendously. But the interesting correlation between gold and the US 10-year is that gold is now selling off, breaking key supports. If the US 10-year really starts to sell and falter, and if it breaks this yellow line around this 2.3, 2.4 mark, I mean, you can argue that it's an upsloping trend line. So the more days that pass, the higher this line gets. The less days that pass, or sorry, these are weeks, so the less weeks that pass, the lower this gets. So right now, if interest rates were to collapse, you would have to pierce the 2% mark. Next week it would be around 2.1. The following week, 2.15, so it is increasing, but that's the key level. We do not want this trend line to break, because when you had these trend lines break on interest rates, you arguably led, that was your signal, as this trend line, these important trend lines, and we have them going all the way back. We have one here in the 1980s. You have another one here in the 2003 to 2007 before the housing crisis. You have this one over here, which was your negative cycle in 2012 all the way to 2014. Market started rolling over. And then you obviously had it in 2016 rally all the way to 2019. And then you started crashing, and that led to your COVID collapse. So once you start crashing and breaking these key uptrend movements in rates, along with gold selling off, that signifies that liquidity is being sucked out of the market. Massive institutional money in the credit markets are slowly positioning and dumping major liquid assets, which are going to put a tremendous amount of liquidity strain on the overall economy. So lowering interest rates help with liquidity, rising interest rates don't, but there's a period where falling interest rates too fast in an inflationary environment often will cause a systemic collapse in the overall equity, and really any of the asset markets will take a massive hit. So let's continue to monitor if gold sells off. Let's continue to monitor if the US 10-year or realistically the 20-year or the 30-year, whatever you may be want to watch. I just follow the 10-year. I've over the years I feel like that's the best and most accustomed yield that I've gotten used to analyzing. but you can realistically use a lot of the different yields in the credit and bond markets to identify similar patterns and cycle trends. So let's continue to monitor. I'm going to get really nervous if interest rates start breaking this 2.7 mark and gold starts selling off. Now, if gold starts to hold and rally up, that's a different story. We'll reanalyze. But for now, it's you do not want to see the correlation where rates are falling substantially and gold is also falling substantially. And that's kind of what we're seeing right now. It hasn't broken the key levels yet, but we're certainly watching. One of the reasons the markets were under pressure in the morning and why gold is under pressure, if we simply look at the DXY, look at this surge. I mean, such a powerful move. We did add to our UUP short because we are short the dollar. But nonetheless, if we flip to the monthly chart, just to get a huge look at this beautiful channel. And you can argue, say that we kind of hit it. My line might be off a little bit, but you're very close. Even if you don't hit it, you could have one little more push up to the 107 mark, but you are into major resistance. And still on a technical basis, you have this reversal candle. It's a monthly candle, so it has to close. This candle has to close on a monthly basis to potentially set up confirmation for the next candle. So until we have this month and the next month, so 2 months worth of data, we're not going to know if this is the top in the dollar. And potentially the dollar can continue to move higher. Right now we're kind of seeing, and when we look at the DXY, this dollar, we have to remember it's only made up of the 7 G7 countries. So right now Japan is just printing their currency to oblivion, and this is helping prop up the DXY along with all of the other currency pairs, because when you're printing, billions and billions to suppress your yield curve control while other people are actually in forms of tightening, it's like you have, a 2-on-1 battle. You're trying to suppress your own yields, and then you're also trying to be competitive globally, but you can't because everyone's raising their rates globally except for Japan, and it's not an economic outcome that ends in a good way for the people of Japan, and ultimately for the people that also sell their treasuries and debt to Japan, and that just happens to be the United States of America. They're the single largest buyer of U.S. treasuries is Japan, bigger than China. So if Japan starts to default on many things, you certainly know it's going to cause a ricochet, a contagion effect across the global equity markets. So let's just take a look at the UUP just to get a sense where our entries are. So the UUP, let's go to the weekly chart. The UUP had this massive gap up. We added around this 28.45 level. It's basically closed right on that. Our average right now is 27.99. So obviously when this does have a final move, and we still have plenty of room to add. I mean, you can see by this chart that there is a potential to trade even a little bit higher up to, let me just fix that, even potentially a little bit higher to the top of this channel, if I can actually get a thing to move that. There you go. So you can potentially see we could have a blow off top, and this might come in the form of if the Japanese start losing control over their yield curve and their currency, and if they start coming to the table with bigger and bigger bazookas of money, which is what they've expressed, then ultimately the DXY should consolidate or should continue to skyrocket higher as the dollar milkshake theory in a sense starts coming to fruition, where the other weaker currencies start really dissolving against the stronger US dollar. But eventually, as we go through these cycles, the dollar collapses, dollar has a hard collapse. So despite in the short term, this could have a pop based off of an economic collapse in potentially Japan or the Eurozone, eventually that collapse would spread over as contagion into the US and North American markets, which would ultimately then start driving the US dollar down along with all of the other assets. Eventually people are not going to want to hold the dollar. Their declining GDP could contract at a faster rate than most people expect. And if that's certainly the case, they become a bit more of a risk in the sense that they're mathematically less likely to pay back their debt if their economy growth is starting to slow at a faster rate than people have anticipated. So lots to consider. Overall, fantastic day for us. Once again, our portfolio is flying high through the start of Q3. If you've been taking our trades with us, again, I mean, we closed Q2 up 25%, and I think we're even up from there. I haven't done the math, but I think after today's rip in energies, we're probably up to a nice 28%. We had a couple closed winners. We had some longs perform exceptionally well. So tremendous job already starting Q3 off on a winning note. Let's continue to monitor things as they come. There's going to be lots of things as we head into mid-July. My plan moving into basically the next 2 weeks ahead of the Fed meeting is, you've seen this trend over the last few Fed meetings that you've had a market bounce on the Fed day. I think that trend may change now because the markets are getting kind of used to and accustomed to the Fed saying, yes, we're going to, we're going to be a little less dovish. We're going to interpret the data. We're going to support the markets if need to, but we need to get inflation under control. I think they may take more of a hawkish stance this go around. Just as midterm elections come around, Biden's polls are in the toilet. I mean, they're lower than Mariana's Trench. That being said, he's really going to apply some pressure, I do believe, to the Fed and Jay Powell, even though they really shouldn't be applying political pressure. They do, and I do think we're going to get more of an aggressive hawkish Fed. So my plan over the next 1 to 2 weeks, if this market continues to bounce, we're going to continue to sell our long positions. We have quite a few long positions in the money. There's some that are out of the money, but I'm going to look to unload our long positions and become more net short on the market, because I do believe that this market's next down leg is going to be pretty fierce. And I do think there's a lot of optimism starting to creep back in the markets after the July weekend. People are going to review their portfolios and they're not going to realize how much they're actually down. And I think it's going to be a little bit of a rude awakening. There could be that sense that people look at their half a year statements and say, oh my goodness, I've lost a shitload of money in Q1 and Q2. I better start liquidating some risky assets just so that I don't lose more. So we could even see more of a liquidity crunch moving into Q3, Q4, especially on the back of now mainstream is picking up a contracting GDP for Q2 in the States, and we've been preaching that for months and months and months, and we've certainly profited tremendously. And now we're going to be positioning ourselves to capitalize on the next turn in the market. And I do think we get that short-term bounce as the yields fall, but I don't think that bounce will last very, very long. So thank you all for being members. Congrats on the profits. Please give this video a big like down below, subscribe, and please help share all of my trading information to as many people as possible. I do think people need a lot of help with what we've already